Welcome to the Lend Academy podcast, episode number 103. This is your host, Peter Renton, founder of Lend Academy and one of the co-founders of Lend It. It's not very often on the podcast that I get to talk about something completely new, something that we've never talked about before. But that's the case on today's show. I'm delighted to welcome Thomas Sponholtz and Jim Riccitelli. They are co-CEOs of Unison. Now, if you haven't heard of Unison, they're a fascinating company. They're in the real estate space, and they have introduced a brand new product, an equity-based product for individual homeowners. And we will get into this in some depth on the show, explaining exactly how it works, how they've been able to do it, and the fact that they actually started this just before the financial crisis, and they are still in business today, which is an amazing story in and of itself. But we talk about the product, how it works, what the benefits are to homeowners, and obviously the benefits to investors as well. Hope you enjoy the show. Welcome to the podcast, Thomas and Jim.
Thank you, Peter.
Thanks for having us.
Okay, so let's get started and give the audience a little bit of personal background about yourself. Why don't we start with you, Thomas?
Yeah, thank you, Peter. My background is really in consumer finance, capital markets, investment management, most typically in building or managing very large-scale consumer finance and investment products. For example, did some of the first securitization of mortgages and assets in Europe. Actually built the first CMO in Europe, and then in the United States built various investment programs for pension funds, endowments, and sovereign funds. The last place I worked prior to starting Unison was at Barclays Global Investors, which is now BlackRock, where I co-ran the fixed income group, which is about $120 billion fixed income group, where we managed, again, for pension funds, endowments, and sovereign funds globally. And we also launched the fixed income iShares. We launched different fixed income alternative businesses. And really just my career has been spending innovating on the consumer product side and then turning it either into a capital markets product or an investable product for investors with long liabilities.
Okay, and so where's your accent from?
Denmark.
Denmark, okay. Okay, great. Now, Jim, why don't we get some background on you as well?
Sure, thanks, Peter. I have a varied background, actually. I was involved with Nomura's commercial real estate business for quite a while. That was the largest commercial lender in the country. I did some venture capital work at Nomura. I ran a venture fund for Nomura that invested in financial services startup businesses, so got to see a lot of innovation and business models by entrepreneurs through that avenue. I was involved in, I ran a residential lending business in Arizona for a while. And earlier, I did some software development and operations management for financial services as well. So all things that, come to bear when you're building a company. So I think the varied background has been helpful.
Yeah, sounds interesting. So it sounds like a pretty good combination there. So then why don't you give us a bit of background about the history of the company and what happened what caused you to start Unison?
Yeah, I got the idea about 12, 13 years ago. Again, I was working at that time at Barclays Global Investors, again, managing large portfolios for really the largest pools of assets, again, long liability tied investments. And we had, as a business, grown tremendously. And we were looking around for large asset classes we could add to our clients' portfolio that would be beneficial and additive to their investment program. And the first place I looked was really residential real estate. Again, we were already invested in fixed income, but residential real estate popped out very quickly because it's the largest asset class both globally and in the U.S. It's also housing and residential housing contribute about 40% of CPI and about 16% of GDP. So it's really the biggest component in the U.S. economy. And yet our investors had close to zero exposure to the asset class, which by itself, it doesn't make any sense because most big and large investors like to have a diversified exposure to the economy, which is tied to their liability in their plan. Mm-hmm. So there was pretty obvious that there could be a potential need. Then we start looking at why didn't they have exposure to the asset class today? And the answer very quickly came that there was no way to get efficient exposure to the asset class. And when I say asset class, I really mean the price exposure to residential real estate as an asset class and nationwide exposure. And the only way to do it would really be to go out and buy tens of thousands of homes and renting them out. And while that's a good idea when housing is cheap, it also comes with a tremendous amount of administrative cost in maintaining and being a property manager of all these homes, which can be a good idea, but it didn't match the objective we had, which was really to get at the inflation component of the U.S. economy related to housing, which again is the liability that investment managers are trying to outperform the type of investors we were focusing on. So that was the genesis of the idea. And then very quickly we said, well, okay, it's pretty obvious that they would be very additive to a large pool of assets to get exposure. But who owns it? And when you look at the consumer, actually homeowners own the equity in the United States, right? So the asset class itself in America is about $25 trillion. And 25 to 30 trillion, depending on whose measurement you look at. Mm-hmm. And roughly 1/3 is mortgaged and 2/3 is equity owned by individual homeowners. And the individual homeowners have no way of getting liquidity for this asset that they own, which is typically the largest component of their net worth. So the first idea we came up with was, wait a minute, we could be liquidity providers to homeowners so that they could make a partial sale of this equity they own in their home. And then we could scale that and then provide exposure to the asset class on the investment management side. That was really the genesis of the idea. And once you build on that, it becomes really interesting because there's so much history and data that you can actually build high-quality investment programs to provide this nationwide exposure to investors. And for the consumer, you can create a consumer product that really matches the long-term nature of the asset they're selling. Like the consumer, for example, when they sell equity to us, they don't want us to have any impact on their experience of being a homeowner. So they want to own the right to own this or sell this equity to us for as long as they want. And that kind of flexibility we could provide by having very long-term patient capital and design highly sophisticated portfolios for these clients on the other side. So that was the genesis and how we came up and with the idea. And the basic idea is old. It's not new. And I say that in the sense that equity financing really exists for corporations can obviously finance with debt and equity. Commercial real estate can finance with debt and equity. And now what we're bringing to the world as new and adding to the system is that now homeowners can also finance their life as a homeowner with debt and equity. Mm-hmm. It's additive to the whole system.
Right.
That's really the big idea here.
Right. And so I believe you launched this, was it back like 05, 06 timeframe? Is that correct?
05, correct.
05. So
that was the start of the company. The first portfolios were built in 07.
Right. Okay. So you launched at an interesting time, to have a residential real estate product launching in 2007. Obviously, you didn't know what was ahead of you, but so you launched the product, and you're still here. We're talking. How on earth did you? What happened? Tell us what happened, because obviously we all know the financial crisis was predominantly led by real estate, residential real estate, and you somehow, it looks like you guys have survived in some form. So talk us through a little bit of the history then from 2007 till getting back into where we are when you're sort of coming out of that period. So what was that like?
Sure. This is Jim. It was a pretty wild time for us going into the crisis. Let's quickly talk about what had happened in 2007. We experienced a lot of demand for the initial program, mm-hmm. which, as Thomas said, is the program that allows an existing homeowner to unlock some of the equity in their home. We were advertising on television in 14 different states, and that was our primary means of reaching consumers, TV and radio. We had about 14,000 consumers that had contacted us and were in our pipeline. And we were scaling the company up, and things were going really, really, really well. And then the crisis hit, and it was real estate started to plunge. It was a very wild ride we were on. We essentially had to suspend origination. In fact, we actually even considered shutting the company down. But Thomas and I looked at each other and said, this idea is too good. This is something that needs to live in the world. It needs to exist. And so, we're going to stick it out. And we went to our investors and said, would you guys like your money back, or would you like to continue to back the company? And every one of them said, if you guys are willing to ride through this crisis, we're there with you. So we spent about a year coming up with a product that we called Reset, that was a way for an underwater mortgage to be turned right side up. Essentially, the idea was that a lender would forgive principal on the mortgage and allow the homeowner to get a right-sized mortgage, reset, if you will, to the current home value. And then in return for forgiving the principal, the lender would have a share in the upside of the home from today's value. And everyone loved that idea. We spent a lot of time talking to people in the industry about it, but no one wanted to set a precedent that it would be okay for a lender to forgive principal. We were doing this back in 2009 and 10 in the early days of the crisis, and so we couldn't get people to launch that program. We moved on to launching a fund that invested in inverse IO bonds that were significantly mispriced because the prepayment models used by the various players hadn't been properly recalibrated in the crisis. And our discussions with the banks around the Reset program gave us some insight to some prepayment behavior. And that fund did very well. That was a very, very good outcome for us and the investors. And we spent a lot of time in the crisis improving everything we had built before and thinking about how we would relaunch the business post-crisis. Before the crisis, the business focused on existing homeowners, which is the Unison homeowner program. And during the crisis, we realized that on the other end, there would be a great opportunity to repurpose what we had developed for a home purchase, and the Unison home buyer program was born. And we came out of the crisis and with both of those and raised capital and relaunched the business.
This is something, if I may add to what Jim said, is what was tremendously powerful in going through the crisis and now after is the fact that we now have a track record both with the consumer and the investor of having managed both portfolios of these assets through a crisis, the biggest crisis we have had since the 30s in residential real estate. And we also have a track record with the consumer on how we work together through a crisis as partners. And that stress that you put on both the operational capability of the company as well as the portfolios really are very informative for the performance of these assets, which is very helpful for investors evaluating an investment. It's also very helpful for the consumer because they saw how we, in many cases, when a consumer during this crisis got into trouble, we would be helpful as partners with the consumer. And, for example, at times make protective advances and pay their mortgage debt so that the consumer then would make an orderly sale rather than a distressed sale of the property. And thereby the consumer will come out with a clean credit record and some equity.
Right.
Whereas typically a lender would, if you have a lender relationship, which we don't, a lender relationship, well, I'm going to kick you out of the house and you're on your own, and I'm going to make a distressed sale of the property as long as I get my loan balance back. If you're equity partners, you're in it together with the consumer, and the crisis really stressed the importance of partnership with the consumer.
Right.
And the benefits of that to both parties.
I can see that. So when did you actually reboot then with version 2, shall we say? You rode out the crisis, but when did you reboot, and how did you sort of recapitalize the company?
The rebooting was about 4 years ago now. And how we recapitalized is really a function of just the amazing shareholders we had already. The shareholders we started the business with were institutions and high net worth investors that we had worked for in the past or were clients of us in the past. And they looked, this was not VC or private equity funded. This was really institutional funding from partners that saw the benefit of this, what we call fundamental innovation to the system. And,
right.
And it was very long-term patient capital. It was not an evolutionary innovation, if you will. We're not making it easier for a consumer to get a mortgage, right? This was really adding something brand new to the system that was really important. It was homeowners and investors should be able to have equity financing in the system, right, much like it exists elsewhere. And that fundamental innovation, you don't know the path of growth because it's never been done before. So the kind of capital that we were funded with was patient capital that understood the fundamental innovation path, and they also reinvested in the company when we rebooted.
Right.
The same investors.
Fascinating. So I want to actually dig into the actual product itself, because I know you've mentioned too, you have a home owner's product and you've also launched a home buyer's product. So I just want to be clear on how these products work. Can you maybe run us through an example of each and tell us how your product actually works?
Sure. We have a new financial product category for both of them. We call them home ownership investments for either the homeowner or the home buyer program. They're both home ownership investments. It's home finance based on partnership. It's a lump sum of cash that can be used for up to 30 years with no interest and no payments. As partners, we win and lose together with the homeowner by sharing in the change in value of the home when the homeowner decides to sell. So if the value increases, we share in the appreciation. If it decreases, we share in the loss. The homeowner program is for an existing homeowner who wants to unlock some of their home equity without borrowing. They can use that money for any purpose, paying off debt, remodeling their home, paying for a child's education, medical expenses, investing for retirement, whatever it might be. With the homeowner program, the money is used as part of the down payment on a home purchase. This lowers the monthly payment by 15 to 20%, makes it a lot easier to income qualify for a mortgage loan, can increase purchasing power by as much as 100%. It can allow the buyer to reserve some of their cash for other important needs. And it can help a buyer make a stronger offer and better compete in a tight market. And you can see some examples on our website, unison.com, but here's a simple math example. I'll use the home buyer program because they work the same way. So if you understand one, you'll understand both. Let's imagine we have $1 million purchase price and an 80% mortgage loan for $800,000. So the buyer needs a 20% down payment or $200,000. We typically provide half the down payment. So we and the buyer each contribute $100,000. They own the home. They have all the occupancy rights. We're just an investor alongside them. While they live in the home, they pay the mortgage and the taxes, but they don't pay anything to us. They can use the money for up to 30 years. When they sell, we receive a payment equal to what we originally invested, plus 35% of the change in value, up or down. So if the value goes up, we receive 35% of the increase, and if it goes down, we're going to incur 35% of the loss. So imagine this $1 million home rises in value to $1.1 million, and they sell it. Our payment's going to equal $135,000 because we invested $100,000, and we're going to have a $35,000 profit equal to 35% of that change in value. And the homeowner will keep 65% of the change in value. It's important to understand that the homeowner also keeps all of the equity they create by paying their mortgage loan down over time. And if they make home improvements that increase the home value, there's a process by which we adjust for that so we don't share in any value created by improvements either. And they can buy us out anytime after 3 years based on an appraisal. So that's the basic operation of the program, and they both work the same way.
Interesting. So, and obviously you've got all your regulatory ducks in a row. It sounds like there's, when someone goes along to a bank and wants and has in your example, say they want to get an $800,000 loan and for $1 million house, they said, oh, by the way, we're putting in 100 and this other group are putting in 100. I imagine the bank, because you're not a household name yet, and the bank probably has never even heard of, I imagine many banks have never even heard of this concept. So how do you approach those conversations?
Well, that's part of what we've done in laying the groundwork with the industry over the past several years. The homeowner program is, in one sense, a little bit easier to launch into the market because the transaction is only between us and an existing homeowner. Mm-hmm. In other words, they might have a first mortgage on the property, and we're just going to put a second lien position in behind an existing mortgage. So we don't really have to get the industry's acceptance in order to do that. The home buyer program, we absolutely have to have the acceptance of the industry because we're providing financing that becomes part of a home purchase and is originated alongside the origination of a purchase money mortgage. So we started at the top of the heap with the regulators, the FHFA, we've been to CSC, the CFPB, the FDIC. Those were very successful review processes. And every lender that works with us undertakes a very significant due diligence process with us and gets comfortable with how we operate, our sources of funding, the nature of our agreement with the homeowner, and everything you can imagine there. And that's part of the building of the groundwork, if you will, to partner with the industry. We've now integrated for the first time equity finance into the U.S. housing and mortgage finance system. Mm-hmm. So that's quite a feat to do, and it took a lot of effort on our part.
Right, I know it's the most mature asset class we have, pretty much, and it's something brand new, which it's hard to even imagine that there is something that's a relatively simple concept but hadn't been done before. So I want to ask about duration here, because you said that it was a minimum of 3 years, maximum of 30. What are your expectations around the duration on average, that each homeowner is going to, your money's going to be tied up?
This is Thomas. The short answer is 10 years. And then the distribution around the 10 years is pretty much a normal distribution, meaning that the average is around 10 years, and then some homeowners, of course, move sooner or sell their house sooner or buy us out, and others stay in their home for 10, 20, 30 years. So we don't interrupt or in any way impact how long people stay in their house. We learned that we have the same duration as typical housing, right? On average, right? So we that's what we learned by going through the crisis. We don't really impact that. People go on living their lives the way they normally do, and by us having as part of the financing of the home doesn't change that behavior.
Mm-hmm. Yeah, that makes sense.
Obviously, very patient capital again, because there's no coupon payments like on a fixed income
right.
instrument. There's no cash flow between the time the investor puts the money into a fund and the time they receive cash flows. There's no coupon. There's only runoff of the portfolio.
Right.
And houses turn over.
Yeah, that makes sense. So I just want to talk a little bit about underwriting, because you've got an interesting product here, because you need to underwrite both the property, I imagine, as well as the borrower. Can you tell us how you approach your underwriting for each individual deal you do?
Sure. The property is generally more important to us, but we look at the credit quality of the homeowner as well. We do need to make sure that the homeowner can afford to pay the mortgage and taxes, basically take care of the property. But since there's no monthly payment coming to us, we do have more flexibility when thinking about credit underwriting. And generally, like with the home buyer program, a good rule of thumb is if the mortgage lender is comfortable with their credit decision, we're going to be comfortable with the credit on that client. For the property, we do single-family homes, condos, planned unit developments. We'll soon be doing multifamily. We'll soon be doing rental properties. We haven't introduced those yet, but they're coming. We don't invest in properties that are sold by flippers. But the most important criteria about property underwriting is that the property has to be typical for the neighborhood. The reason is that we want to know that the value of the property can be determined with good precision. Mm-hmm. Atypical properties can be difficult to value and difficult to sell. So, unusual properties like geodesic domes, log cabins, farmhouses, those kind of things will typically not qualify. Some rural properties that are way on the outskirts may not qualify, but in general, most properties that are typical in the areas that we operate do qualify for our program.
Right, and then what about, how do you approach it? Because, obviously everyone knows real estate is local, and it's, what happened, you just look at the financial crisis. I live in Denver, and while we had certainly a downturn and we bounced back pretty quickly, then you've got other like Vegas or Florida that had some challenges and Arizona. So how do you take that into account as well, as far as local, the local environment, the local economic environment?
Well, as Thomas mentioned, these are longer-term holding periods, so local economic conditions can change from time to time, but we're long-term investors, and we're not really trying to time the markets that we invest in. Over long cycles, real estate tends to perform fairly consistently.
Yeah, okay.
If I may add to that, it's important to keep in mind what we're actually offering to the investment community on the other side in order to answer your question, Peter. The investors that invest with us are expecting us to turn every home into an investment, meaning we're basically taking all the data of an individual house and turning it into an investment, much like you would evaluate a stock or a bond. So that whole transition is what happens on the investment management side. So we can talk about volatility, distribution of return, the pricing. We have 10-year forecast on every house in America. So we have a very sophisticated data infrastructure and pricing structure and what do we call turning a house into a security for a portfolio management system. So that then goes into building nationwide portfolios for the benefit of the institutional investor. They are not expecting us to time the markets. They want exposure, much like when I built index funds on the fixed income side or iShares. You want exposure to the asset class. You want efficient, diversified exposure with a low cost and low drag on returns from expenses. That's what the institutional investor wants. So we're building nationwide portfolios by looking at every single house and what I basically call decomposing it into investment characteristics and then reaggregating them up into portfolios. And that means that, to answer your question about do we look at local economics, of course we do, but that just tells us how this investment looks like. Much like if you invested in the high-tech industry, you would want to if you have an index fund in high-tech or in the U.S., you're not making adjustment about whether tech is cheap or cyclicals are expensive. What you're doing is you need to understand every single investment component that you own and then aggregate the portfolio to match these long-term liabilities that they have. Because if their local economics go down in one area, that also means the liability goes down. So our job is to outperform the liability by investing in this asset class. It's not to make judgment calls about whether it's high or low.
Right. I get that. So you mentioned nationwide. Are you open in all states, or what states are you open in today?
We're currently in 13 states, but the states that we are operating in contain most of the largest metro areas in the country. So the footprint comprises over 50% of the U.S. housing stock. We're basically in the West Coast, the 3 states on the West Coast, and then the Northeast from Virginia up through Massachusetts. And we're also in Arizona and Illinois. And we have plans to enter some more states later this year.
Right. Okay. So, and we're running out of time, but I have a couple more things I'm very curious about. So how are you marketing your offering? Because I imagine that it's not like a credit card offer or even a home loan offer that everyone understands what a home loan is. I can explain it to my 8-year-old and she would totally get it. How are you marketing?
So we market through partnerships with national lenders and real estate brokers. We've trained thousands of loan officers and realtors on our programs, and they're on the front line seeing deal flow every day and how the program can help, and they're introducing the clients to us. We also market direct to consumer. Everything you can imagine that might be internet-based, we have strategies there. We do direct mail. As part of our direct-to-consumer expansion, we recently launched some amazing instant pre-qual tools on Unison.com that people are enjoying using. We've been winning some financial innovation awards lately, including the Best of Show at Finovate and Benzinga. And we get an enormous amount of press. So a lot of clients actually come to us after reading about us in the press or seeing us on TV or hearing us on the radio. And there's a very strong education component to this. And I think that gets to the heart of your question. Education is a key component of our business model. We're very proud to provide all of our clients with a very thorough education. We consider that a key part of being a partner. We have a mandatory education process. It involves video training, other knowledge-based resources. Each client has a program specialist assigned to them for the duration of the transaction, and their number one job is making sure the client is properly educated. We invite all the clients to bring their family and advisors into the education process. Each client goes through a knowledge review process that enables us to assess their understanding of the program features and close any gaps they might have. And our clients love this approach. They love the fact that we are not leaving them to their own devices when it comes to a financial product like this, and they see it as a breath of fresh air, not something they're used to seeing commonly in financial services. We get a lot of compliments. We get compliments from our lender and realtor partners as well. Yeah, okay, that makes sense. So I want to talk about the investor side. I mean, what does
Who is investing with you guys? What is the vehicle you're using? And, it's the sort of the scale you guys are at. Can you tell us about that side of the equation?
Sure. As we touched on before, it's primarily pension funds and endowments that invest in our funds. So they're 30-year commingled fund structures. So it's a 30-year commitment that investors provide us with. In terms of the scale, the current scale is that we have investment capacity of, I believe it's just north of $300 million at the moment. We have commitments behind that in above $2 billion at the moment, and that's growing very rapidly. Similarly, on the origination side of our business, it's growing leaps and bounds. So it's important to obviously have evergreen demand on both sides of the business, both on the consumer side as well as the investment management side.
Mm-hmm.
And that's what we've done.
Right. Okay.
It's evergreen demand rather than investors that go in and out as they have, if they think real estate is good or bad or high or low. That's one type of investors you can seek. We seek a really long-dated 30-year capital of people that want exposure to the asset class in a nationwide.
You couldn't have it any other way, really, could you? Given the duration of your products, so that makes sense.
Consumers wouldn't do business with you. Here today, gone tomorrow. It doesn't work.
Right.
And this partnership with originators also doesn't work if you're not constantly ready to fund their consumers.
Right. Okay, so what's next for you guys? Are you just you mentioned potential new products? I mean, you're just consolidating what you've got and expanding it in new states. What's on your roadmap?
Yeah, all of that. We're going to continue to lead this category that we started, home ownership investment. We have plans to expand our footprint, the number of lender and realtor partners we have. We're going to move into additional distribution channels and continue to increase origination volume. We have a lot of new programs in the works. We mentioned rental properties and multifamily earlier. We have a couple of other things that are coming soon that are quite revolutionary. So keep an eye on Unison.com for more updates. It's an exciting time for us.
Okay, well, it's a fascinating company, a fascinating concept. I really appreciate both you guys coming on the show today. Thanks a lot.
Thank you, Peter.
Thanks, Peter.
Okay, see ya. As I said on the show, I think it's really interesting to me that we have, such an established asset class and a product like this that really is pretty simple conceptually and is implemented in many other asset classes, this whole concept of equity ownership. And it hasn't happened here in residential real estate. Now, I think that the challenge obviously is that, until they get, an entire industry with, 25 competitors all coming in and trying to do something similar and it becomes just a commonly known thing. Oh, do you want to put all your equity down, or do you want to partner with an outside company to join in you and putting equity down? And that becomes just a normal part of the conversation when you're buying a house. Obviously, we're not there yet. We're nowhere near that. And I think eventually this either stays a very niche industry that is very small, that no one really, the major segments don't take up, or this becomes something that is just commonplace. I tend to think conceptually there's so many advantages for both the homeowner and investor that this could become a very significant segment, a sub-segment, shall we say, of real estate going forward. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.